Every week, the Payne family cuts straight to the real financial story.
The one question, Bob, everyone's asking is, are we in an artificial intelligence bubble? You've been through boom and bust. What do you think?
No hype, no myths. Just what actually matters to your money.
Does feel very similar to what we experienced in the 90s. Where are we, though? Are we in 1995, 1997, 1999?
Listen to the Pain Points of Wealth on the Red Apple Podcast Network.
Listen, all you New Yorkers.
Excuse me, taxi.
Okay, man, we're looking around.
This is the 77 WABC minicast.
Good morning. This is Mike Stoller for the Stoller Real Estate Report. Retail, it fuels the city. It's a major business effect on the city. So today I have one of the prominent retail leasing brokers, my friend Cory Zelnik, who is the founder, CEO of Zelnik Company, who's going to be celebrating its 40th anniversary in August. So what's going on with retail?
Retail has been very good, Michael, and thank you for having me. We're probably coming into up 2.5 years now of strong retail activity throughout the city. Luxury has filled up. It has leveled off, but luxury had a big run, and all of Madison Avenue, what we call the Gold Coast, is all filled up. The Meatpacking District, which also has luxury, is very, very saturated now with luxury and very few availabilities. And if you look at just sort of the main markets throughout the city, they're pretty filled up with tenants, and space is hard to come by in what we'll call the main streets.
The other day when we spoke, we spoke about buy now, pay later. What is that?
Buy now, pay later. I told you was
a new acronym.
A new acronym for the customer. So holiday sales this year were very strong. They're saying upwards of $1.7 trillion spent throughout the holiday sales. But they said buy now, pay later. So it's a lot of credit card usage. And so that may cause some concern going into next year because obviously people are going to have to pay those debts. But there was a much more conservative shopper in terms of value. It wasn't the luxury brand so much. It was the value shopper. But there was a lot of it.
And they project the value shopper to continue to be strong.
Yes.
Okay, who do we consider the value shopper? Well, TJ Maxx?
Well, the tenants, TJ Maxx. Burlington, for example. Burlington has been on a tremendous roll throughout the country, opening stores on a very, very regular basis. They're selling stuff on the cheap. It's not secondhand, and the thrift world is its own world in and of itself. But Burlington, gets the stuff that wasn't sold at Bloomingdale's, and then they sell it in their stores. And they have been taking advantage.
What's the difference between Burlington and TJ Maxx?
There's actually some similarities. I think if you put them on a scale, Burlington might be a little bit lower in terms of affordability and pricing, but they do the same type of thing. They'll take Bloomingdale's extras or Nike's extras, and then they resell them at much lower prices. But Burlington went out in a rage, in a good way, of grabbing vacated Bed Bath and Beyonds around the country and things of that ilk. So there hasn't been a lot of development going on retail-wise, and so supply has been short. Even though we regularly read about bankruptcies, a lot of the space has been absorbed.
Let's talk about the luxury market, which they were selling the properties. Why are these major companies buying retail properties?
It was primarily Europeans that bought those properties because if you ask them, they'll tell you they have 100-year thinking. And so every 10 years and every 15 years, they got tired of resetting their rents that most often went up, and they decided to make the investment and commit to the city. Most of the properties that were purchased sit in some of the most prime areas of the world, Fifth Avenue, Soho. These are considered prime retail areas throughout the entire country and the world even. And so they decided to make a long-term investment into the markets.
What's happening to existing mall space that's been around?
Well, there are different type of malls, right? There's the outdoor open air mall, and then there's the enclosed mall. I think a lot of the remaining enclosed malls, which there are not a lot of, are getting repositioned a little bit, but they are starting to fill up. Again, there's not a lot of new development, so the old mall is now sort of the new mall, and people are starting to come in to shop. And they see that because going back to my holiday sales report of the 1.7 trillion, 250 billion of it, a huge number, was online. But the majority of it was people going to the stores to shop, and so the malls are making a little bit of a comeback.
Okay, the trend is also for smaller stores, correct?
For the most part, this small today, 2,000, 2,500, maybe 3,000 square feet, and then you jump from there to the box, which is the Burlington and the TJ Maxx's that we were talking about. So you go from there to there. There's not much in the middle in that 5, 6, 7, maybe even 10,000 range of a tenant looking to grab space, because around the country, we've all read about the drugstores that are closing, not just what we see here in Manhattan, but around the country. A lot of there are Walgreens and Rite Aids that have all come back to the landlord, or they're sitting there vacant, and they're all 10,000-foot boxes.
So what are replacing them? The TJs or some of the small supermarkets?
It's a mixed bag. So the TJs, they're too small for a TJs. Around the city, we've seen a lot of supermarkets, local operators with multiple stores stepping in and taking the position. Around the country, I've heard stories where they literally took a Walgreens box that was vacated and turned it into a car wash. They went right through the building. They set it up as a car wash. I've heard that story. I've heard medical urgent care taking over some of these spaces.
Are we seeing more medical urgent care in our region?
They have proliferated the market.
No question about that.
Yeah, they're around. So they'll continue to pick and poke now and fill gaps, but there aren't a lot of neighborhoods you can go into now without having seen one or having them operate. A few of them have come almost like any retailer. There's the City MD, which is the class. There's One Medical, which is also the class, but then there's these other ones that popped up.
Right, the mom and pops,
and some of them have faded away.
No question. Let's talk about the restaurant business.
Sure.
What's happening on that?
Restaurants, and I've been saying this now, my old adage, if you could vent it, you could rent it. So when you see these old restaurants, they're opportunistic for a lot of people, whether it's a brand or an entrepreneur. If they can step into an old restaurant where that infrastructure is in place, the venting systems, the hoods, that's a big advantage to a new tenant. And that's good, mostly beneficial to the entrepreneurial restaurateur. But if we get a restaurant that comes on the market, I will have five offers in less than a day of interest. There just seems to be a tremendous entrepreneurial spirit for the restaurant business.
Okay, with regard to that, what's happening with the ghost kitchens?
The ghost kitchens, they, for the most part, came and went.
Would you want to explain to my audience what is a ghost kitchen?
Sure. The ghost kitchens evolved during COVID, where basically you would take a box that it doesn't have street front, not necessarily a retail street, and really act it as a kitchen for multiple brands. And certain tenants used these kitchens because it was only about delivery. No one was coming to the restaurant. And so it was really just a kitchen. You didn't really see it, so they called them ghost kitchens. What's changed a little bit along those lines is this brand called Wonder, which is, we see them around the city. They opened about 25 locations throughout the city and the boroughs, and they are what I call a front-facing ghost kitchen. So they do have street presence, but you go there and they have 10, 12, maybe 15 different cuisines that they prepare out of their kitchen. And it's mostly a delivery business, but a lot of them, and we're sitting above one now, they have seating so you can eat in as well. But they've continued to look to roll them out. They have private equity money, and they put out a lot of stores really quick.
What about the coffee shops?
We're going to see a little bit of a changing of the guard. Starbucks is going to be Starbucks, but they've made public about a lot of closings. And then you have this brand called Luckin, They're out of China. They actually have over 20,000 units in China. They kept Starbucks out of China. They had some financial issues about 5-7 years ago. They've worked through them, and now they're starting to penetrate Manhattan. And they've, in some cases, grabbed some old Starbuckses. And I think you'll continue to see that, where you'll get an entrepreneurial coffee company step into an old Starbucks space.
What about the health clubs?
Gyms. Yeah, well, Lifetime Fitness has decided to make a big push into the city. They're getting ready any day now to open up about a 30,000-foot space over on Fifth Avenue, 40th Street, out by Bryant Park. So they made a big investment, and they're not just gyms anymore. I think you have your
right. The gym is inappropriate.
The gyms, yeah, it's always going to.
It's a differentiation.
Yeah, I think that you'll always have gyms, right? There's always going to be the gym where you can just go lift the weights, things like that. The Planet Fitnesses are still gyms, but
they've raised their rates to now $15 a month as opposed to $10.
I didn't know that. But what you have with the Lifetime Fitnesses is that they're making them more like wellness centers. So you can come in and you can lift your weights and you can run on your treadmill and you can do all your classes, but you can also, they have spa treatments and things like that. So it's much more expanded. And then there's a next level that I would go nowhere near calling them gyms, are these flat out wellness centers where you can do ice baths, saunas, steams, facials, and so on and so forth. Very high-end luxury, a lot of money put into them in terms of their build-outs and things like that. So I think you're going to continue to see some of that.
Okay, in conclusion, what do you look like for 2026?
I think 2026 is going to continue to be strong. There seems money still is being spent, so that means that we need stores, and I think that the city's going to continue to fill up, especially in the tertiary areas, because that's where the space is. And I think that retail will be a factor going forward in a good way. We'll have some challenges with the new mayor and some of the minimum wage discussions he's talking about. But I think I'm very, very bullish on retail in New York City.
I'd like to thank Cory Zelnik for being here today.
Thanks for having me, Michael.
Every week, the Payne family cuts straight to the real financial story.
The one question, Bob, everyone's asking is, are we in an artificial intelligence bubble? You've been through boom and bust. What do you think?
No hype, no myths. Just what actually matters to your money.
Does feel very similar to what we experienced in the 90s. Where are we, though? Are we in 1995, 1997, 1999?
Listen to the Pain Points of Wealth on the Red Apple Podcast Network.